Good afternoon. My name is Shola Salako. When I was originally given the slot, I was told I had 15 minutes. When I started preparing what I was going to say, I decided that 15 minutes wasn't enough. However, I will keep to time, so I will speak for about 5 to 10 minutes and then give you the opportunity to ask me questions. I'm speaking in a private capacity. I will cover the De Beers UK pension scheme, for whom I am the pension fund manager, look at some of the issues for UK schemes, some of the challenges for schemes in the UK, and then, as I said, an opportunity for questions. Now, the De Beers UK comes under the De Beers SA, which I'm sure some of you know is a mining company, mines diamonds in Southern Africa. The company splits itself into two parts, Northern Hemisphere and Southern Hemisphere. And as a pension fund manager in the UK, I am responsible for all aspects of pension provision for UK employees, wherever they work for the company's operations. This means we have a UK scheme which, by UK standards, is a medium-sized scheme. It has assets under management of about 900 million. There's also another offshore scheme with assets under management of 130 million, for which I'm also responsible. And then there's a small defined contribution section, which has tiny assets of only £25 million. All the numbers I'm giving are pounds. There's about 2,500 members in the schemes. We are presently invested. The thing to keep in mind is that for us, we know what our liabilities are. They're fixed, or they're mainly fixed. Most of our members are pensioners, or they're what we refer to as deferred. So our asset allocation reflects that. So we're presently invested 35% in equity. I won't go into the detail. 56% in fixed income. That covers various types of fixed income. 7% in property, and then 2% in cash. We are 82% funded on a technical provisions basis, and the offshore scheme is even more. The liability is more fixed, because with that we only have pensioners and deferred. So there's just 25% in equity. There's 63% in gilts. There's 10% in absolute return strategies and 2% in cash. One of the things that is quite important for occupational pension schemes in the UK is the regulatory environment and framework within which we operate. It means we have to take notice of the pensions regulator, and those of you who work in the UK will know them very well. We have to take notice of HMRC, who on an annual basis issue new legislation. We had some more interesting ones this year. We have to take notice of and report for the Pension Protection Fund. In the UK, there's a drive from defined benefit to defined contribution provision on the occupational side. There's also a faster move to closure to accrual. There's obviously issues around sponsor covenants. There's the triennial actuarial evaluations, which we go through. And then there's lots of work and lots of issues around governance structure. As I said earlier, the De Beers UK is part of De Beers SA, which has mines in Southern Africa. That's South Africa, Namibia, and Botswana. And also Canada, actually. So I suppose the thing is, we are invested in, the UK scheme is invested in emerging markets or growth markets, just not in Africa. And I suppose for the larger group, they obviously have pension schemes in Namibia, Botswana, and South Africa. So in their home markets, they are invested in their home markets and in the regional or wider African markets. So I suppose what I would say is that as the group is a major employer in Southern Africa, I believe that you can consider the wider De Beers SA Group as an investor in Africa. If I move on to the challenges of running a pension scheme, it's not, when I look at my list, I think that these are challenges for running a pension scheme in the UK, but there are also challenges, I suspect, for running a pension scheme wherever you are. These are the tension between returns and risk, the low interest rate environment that we are experiencing in the UK, the drive, as I said, from defined benefit to defined contribution provision, the macroeconomic environment under which we are operating. So, for instance, the central bank policy around quantitative easing, which is really, really important for pension funds as long-term investors. And for obvious reasons, in that it affects bond yields. You probably, we hold fixed income, and we seem to hold a lot of fixed income, because for obvious reasons, we need to satisfy the liability side of our pension scheme balance sheets. There is a growth in absolute return strategy, the offshore scheme, and there's also, certainly in the UK, a growth in liability other matching products. I will stop for now. Yes.
And I'm interested in, I have an observation, and I just want to share that with you and then see how that affects De Beers. Because what we do is we invest in listed equities in African markets. And we have raised a sizable amount of money in the US and in Europe. Now, when I started the fund, I actually had an expectation that I was going to raise a significant amount of money in the UK, because it has a history with Africa. It's, UK companies, Unilever, De Beers, BP, they all know these markets. But the reality is that the UK seems, or UK pension funds in particular, seem incapable of taking a decision. I've actually ended up with what I would call perverse observations, where we pitch to a pension fund manager like yourself. They will invest PA in the fund, but they will not invest institutional money in the fund on the basis that they're taking a career risk when they invest in the fund. But if they lose their own personal money, it's not a problem. Now, why? I just want to understand, what is the inhibiting factor that makes American pension funds are willing to invest, Europeans are willing to invest, even we get investments from Asia, but in the UK, I don't know of any of my colleagues who's been able to raise any money from a UK pension fund. What is there? Is there an institutional problem there?
Sorry, did you? Okay, all right. I'll give an observation. You make a very, very good point. And then I'll move on to Bridget, who's a fund manager for one of the local authority funds. I think it's not, one of the structural issues with pension schemes in the UK is we rely a lot on investment advisors. We really, I'm a trustee of a European fund, and I'm the chair of trustees. Now, when I go to trustee meetings in Belgium, we don't use investment advisors. And when I look at our returns, they're as good, if not better, than the UK. But in the UK, the market means, the way the market works is that most pension schemes, except the very biggest, use investment advisors. So these are your Towers, your Aon, your Mercers, your Hymans. What that means is that they serve a useful function, but it also means they have house views, they have an agenda, and what it means is that they won't necessarily present your ideas or your strategies, and it's not just you coming from Africa. I've heard the same thing from other managers from in other spaces. They won't necessarily present your ideas or your strategies to the pension scheme trustees. And what you have to remember is the way trustees are not always professionals in the sense of they're not CFA qualified, etc., etc. So they do rely on their investment advisors. So I think that means the market to an extent is skewed because, but if you're very large schemes, if you're, let's say, the coal trustees or BP, then you can get your own people who will do the research, who will sit down and perhaps listen to your story and your proposition. And the use of advisors and the reliance by trustee boards on advisors means that it is very, very hard to get a trust board to say yes to that sort of proposition. Bridget?
Exactly what I was going to say. I echo Shola's point of view. It is a very intermediated market within the UK, and to get pension funds to invest, you have to have the buy-in of the advisors, period. And I know that lots of people are knocking on their doors and they don't open the doors because they've only got a small range of propositions that they can presumably score or rate. So yes, unfortunately, that is the problem.
Thank you, Bridget. Thank you. Any more questions?
Any more questions from anyone?
Sorry, there's a lady here.
Elizabeth Waifu, I just can't let the previous discussion drop because it really troubles me. What next? Because if pension funds are being denied access, effectively, I mean, if a certain section of, if a certain type of investment is being, or new ideas are being prevented from reaching the pension funds, surely the pension funds can put some pressure on their advisors to present them with fresh ideas. Because we've got to, I mean, if there is an issue, we've got to fix it. I mean, and those who have the power are the pension fund trustees. Surely you can insist on a broader spread, more diversity in terms of the ideas that are coming through. Get the advisors to do some work. Because it must, yeah, it's true. I mean, it's safe for them to keep presenting the same ideas and tried and tested areas of cautious returns. But they can also work for their money by doing some more research and presenting greater ideas. I mean, how is there a way one can take this forward? Because I don't think we should let that drop.
You're right. You're absolutely right. And it does happen. I've seen it happen in that you will get either trustees or the pension fund managers will say to an advisor, we've heard of this idea, go and do your research and come back to us with something. So it does happen, and it certainly happened in my case where we engaged a fund manager who we had to go to the advisor and say, look, we like what they're saying, we like the proposition, go and do your research and come back. But I suppose we just need it to happen more. It does happen, and you're right in what you say. It does happen, and yeah, we just need it to happen more. I suppose the challenge for us is, I suppose the challenge is that corporates, the sponsoring employers need there's probably a need to have a bigger governance budget. So you have people who can ask the questions of the fund advisors. Sorry, of the investment advisors. Oh, sorry.
And quite a lot of us are actually tapping into the African market, but it's all going through the big fund management houses who have got a little bit of frontier market within their emerging market portfolios. So we are tapping in. There is also, apart from the advisors, a lot of trustees do have concerns about Africa. Again, it's back to the BBC syndrome of the reporting that happens in Africa. And so you do find that a lot of trustees are not that interested, quite frankly. And I think what Africa needs to do is, there's a perception and risk, and there's a mismatch between perception and risk. And what we need to do is actually make that reality. Successful funds, successful investments, and see the reality. And when we start to see that reality, then people will invest more. So it's about, making the reality, get rid of the perception.
Thank you. Any more questions? Okay. Thank you.